हेलो एंड वेलकम टू आवर स्पेशल कवरेज ऑन Q4 जीडीपी। मैं हूं विवेक मित्तल और आज हमारे साथ Q4 जीडीपी पर बात करने के लिए एक स्पेशल गेस्ट जुड़े हैं, हमारे साथ जुड़े हैं मिस्टर पीके बासु, चीफ इकोनॉमिस्ट आईसीआईसीआई सिक्योरिटी से। गुड इवनिंग बासु सर। Sir,
Good
your
evening.
first reaction on the Q4 GDP and for FY23 GDP data.
Well, no real surprises for me. I think the numbers are slightly ahead of the market's consensus estimate. I was looking for real GDP to grow 7.2% in FY23, and that's exactly what the final number has come out as. What is particularly heartening is that the growth is driven primarily by fixed investment spending, up 11.4% year on year for the fiscal year, and up 8.9% year on year in the final quarter of the fiscal year. So the momentum of investment spending continues and is the key factor driving the overall growth of the economy. I think that is going to continue into the current fiscal year, and the economy is in robust shape, essentially.
So how do you see some manufacturing, services and agriculture sector growth in this Q4?
Well, manufacturing recovered. It recovered to 4.5% growth. I think it had contracted in the previous quarter. We already had some evidence of this in the industrial production numbers. So that actually was a key reason why I was expecting that we'll get a recovery in the fourth quarter that'll take real GDP for the full year well above the 7% estimate that the government had, and far above the 6.5% estimate that the IMF had for India. So India remains the fastest growing economy in the world by a considerable distance, particularly, of course, among the G20, the 20 largest economies in the world. And I think we'll sustain that lead in FY24 and FY25.
So, sir, what do you think that by this number, the investor community would be more happy or the government would be more happy? Because the farm sector growth is far over the estimates. So how do you see? Because it's an election year or so.
Well, I think both the government and the market have reason to be quite delighted with these numbers. With regard to the market, I mean, I think we've already seen a quarter of good earnings estimates coming through from companies, and that is just reinforced by the GDP numbers that have just come out. Real GDP is growing strongly. Nominal GDP is also growing strongly, which of course contributes to strong government revenue as well as corporate revenue growth. And with corporate revenues growing, and as long as they can hold their margins, you'll get good EPS growth. So we've got a pretty robust situation relative to a world. I think it's worth understanding that the Western world is close to recession. US GDP in the first quarter of the calendar year grew just 1%. That is 1% on a quarter-on-quarter seasonally adjusted annualized basis. It grew 1.6% year on year. But when you compare that to India, we've got 7.2% growth, also nearly double the pace of growth of China. So we are in pretty robust shape. It's not as if India can't do better. I think India can do even better than this if we can get labor-intensive manufacturing to really gather momentum. That is the missing element of India's growth story. If that picks up, then growth could be, a lot higher. It could be even 9%.
So we are hoping that India should touch this kind of growth pattern again. But sir, how do you see as you just mentioned that European countries are struggling to get the growth of, say, positive growth number, and America is also struggling for the same. So last week I had just seen that the Germany growth was in the negative side for Q1. And it's been continuously for the 2 quarters, because in Q4 there was negative growth in Germany, and then again in Q1 there's negative growth. So do you think that it's a temporary recession, a technical recession, or it's a structural recession, which is going to impact the overall growth for the entire world?
You see, with regard to Germany, it's quite simple. Germany used to receive more than half of its energy requirements from Russia. So for Germany to have effectively stopped importing, or heavily curtailed its imports of energy, natural gas and oil from Russia, is obviously a huge hit on the German economy, and Germany is in recession as a result. Most of Western Europe is pretty close to recession. I think the United States is entering recession in the current quarter. We'll only get correct news of that maybe 6 months down the road, but it's already pretty close to recession now. And unfortunately, inflation in the US is still not under control. So the Fed has to keep raising rates at least a bit more. So the Western world is still struggling. I think what distinguishes India is the fact that the external balance is in good shape. The current account deficit is likely to be only 1.8% of GDP last year, despite the fact that for about half of the fiscal year, we had extraordinarily high commodity prices. We had very high prices of crude oil, coal, fertilizer, vegetable oils. So about half of India's imports were seeing their prices rise at a spectacular pace in the first half of the fiscal year. And yet, the current account remained largely in check. In the second half, prices moderated, so the current account improved. But for the full year, we get a deficit of only 1.8% of GDP in a difficult environment. And this year, I expect that the current account deficit will be very small, perhaps 0.3 or 0.4% of GDP. So that helps a great deal. With that moderation in the current account deficit, you get a natural, it's almost like an effective tax cut for Indian consumers and businesses, because you don't have to do anything, just sit there and you get your terms of trade improving, your import prices coming down, commodity prices, which India is an importer of, are coming down. And that essentially is a benefit to Indian consumers and businesses. And that benefit can then be redeployed in more consumption and investment by the Indian economy, within the Indian economy. And that will provide a boost to aggregate demand and help ensure that we have another year of good growth this year. Of course, the government has done remarkably well with its fiscal position. The fiscal deficit is reported at 6.4% of GDP, but I think, in fact, it's the actual position is even stronger, because revenue is very strong. That enables the government to spend on all its priorities without any real trouble. And I think tax revenue is continuing to grow at a very strong pace. We saw that with the income tax and corporate tax revenue growth in the last fiscal year. It is continuing this fiscal year. And that is what helps the government to keep public investment growing strongly, 30% plus growth last year and this year. And all of that, combined with the fact that that corporates are beginning to invest as well. So private investment is picking up too. The missing element is private consumption. As you mentioned, the strength of agriculture was also actually highlighted in the last RBI statement. RBI said that the Rabi crop is up about 6.2%. So that is reflected in the 5.5% growth in agriculture in the latest quarter. And it'll, I think, run through into the current quarter as well. So we've got a good agricultural situation. Of course, there's a slight cloud on the horizon called El Nino. But if you live in North India, as you and I do, we've had significant pre-monsoon showers, thunder showers, almost like monsoon rain, for most of the past week. The IPL final was nearly wiped out because of rain in Gujarat. So, we basically have rain all over the country, significant pre-monsoon rain. So, if anything, the Kharif harvest, the Kharif cropping season is going rather well. And I think if the monsoon is normal or even slightly below normal, we'll still have a very good Kharif crop year. So that is all good news.
So, sir, how do you see the India's inflation figure for this fiscal? Because if we look at some of the essential commodities like wheat, for example, the price has surged from 21 to 30s level, and the entire country is giving the complaint like price has surged around 50% from the recent past. So, how do you see the inflation figure? Because the rice prices have gone up, wheat, pulses. So, vegetable is a comfortable thing, which is in the range since last 1 year. But apart from this, there is a huge pressure on the government.
Well, yes. I mean, I think inflation is moderating, and there is no doubt that we've had significant cereals inflation. So food grain inflation, rice and wheat prices in the non-PDS rice and wheat prices are still up in double digits on a year-on-year basis, and that is, those prices are moderating. The pace of inflation in non-PDS food grains is moderating, but it's still relatively high. That does need to be contained, and I think it will be contained effectively over the next few months. But it's also worth noting that about 813 million individuals are receiving free food grain at the moment. So from a sort of political standpoint, free food grain distribution is a positive. From an economic standpoint, looking at it purely as an economist, it is not a good thing to keep giving freebies. And clearly, free food grain is a freebie. There's no getting away from the fact that the government is handing out a freebie for the whole of this year to more than 800 million people in the country. That becomes a habit. The important thing is that it shouldn't become a habit for people to receive free food grain. It is more appropriate from an economic standpoint to understand that things are not free, that you need to earn them, etc. So that is happening. Now, with regard to inflation, of course, headline inflation is already down to 4.7% in the latest month. It is likely to moderate further in May and June. So, and the key factor here is that global oil prices have moderated. Global commodity prices, including rice, wheat prices, have moderated. The only price that is rising internationally is sugar prices, and India is the world's largest producer and exporter of sugar. So not really a problem for India from an international price perspective. If some of the moderation in crude oil prices can be passed on to the consumer will be even happier. So that some of that has been slow to be passed through, but I can understand the reason why the government is slow to pass these through, because it wants to encourage Indians to move away from fossil fuels and to go on to using more renewables, which is all good. But if oil prices are so much lower now, crude oil global prices are lower, some of that should come through in the form of pump prices for petrol and diesel and LNG, as well as for LPG, and that will be helpful over the course of the next few months.
So, what's your focus for the crude oil for this fiscal, sir?
Well, I think crude oil, my assumption in models is that crude oil will average about $85 a barrel. It's currently just over $70 a barrel. Brent is just over $70 a barrel. So if it stays around current levels, then India could well see a current account surplus this year. Assuming $85 a barrel average for the fiscal year, we'll get a current account deficit of about 0.4% of GDP. And of course, inflation is moderating. And really, if you look at the last 6 months, we've had 2 months of inflation above 6, but otherwise we've basically had 4 of 6 months inflation below 6%. Likely that in the next few months it'll get close to 4%, and I expect that by October the RBI will be in a position to cut the repo rate by 25 basis points.
And so do you expect the same thing from the American governor also in
No,
the upcoming Fed meeting?
unfortunately, America has a different situation. If you look at the American situation, is that the latest core PCE inflation rate was 4.5%. Month-on-month change in core PCE inflation was 0.4%. That is an annualized increase of 4.8%. So if you have an annualized increase of 4.8%, and in fact, in the first 4 months of the calendar year, the annualized increase is in fact running at close to 4.8% for core PCE every month for the last 4 months. So there is no possibility of the US cutting interest rates. Although the markets were trying to price in a rate cut as early as June or July, there is zero. I mean, at the moment, the probability of a rate cut is zero in the US, to my mind. The likelihood is that even at the June meeting, the Fed will have to raise rates. Although the Fed chair, Jay Powell, at his last press conference, very strongly hinted that in June there'll be a pause. But given what the latest core PCE inflation number is, both in month-on-month and year-on-year terms, I think the Fed has no option but to raise rates even at its June meeting.
So don't you think that that will be detriment for the financial markets, and that will ultimately hurt the Indian economy as well?
Well, it won't hurt the Indian economy. It might hurt sentiment. It might hurt it will certainly hurt equity market sentiment as the markets start pricing in the likelihood of another rate hike. And when the inflation number came out a few days ago in the US, the markets did sell off because markets are now beginning to reprice expectations. I think the latest probability of a rate hike in June is only about 40%. So there's a 0.4 probability of a rate hike in June, but until about 2 weeks ago, the market was actually, many in the market were expecting a rate cut in June or certainly July. I think that can be ruled out. So the US is in more trouble with regard to inflation because monetary growth was too rapid during the COVID period. For 2 years, the pace of monetary growth, M2, broad money growth in the US, was growing at nearly triple the average pace of the previous 60 years. So if you have money growing at triple the pace that is normal, you will eventually have serious inflation. And that's essentially what the US has. If you look at India's case, India's average M3 growth in the 60 years prior to COVID was 15.1%. During the COVID period, M3 growth in India averaged 11%, so lower than the pre-COVID average. And since in the last 1 year, average M3 growth in India has been 9%, even lower. So India has been pretty restrained with regard to monetary growth. But I don't want to overplay this point because money demand in India is also coming down because people are using UPI, phone pay, Paytm, etc. for transactions. And since digital payments have picked up, the money demand is shrinking. And now that 2,000 denomination notes are being removed from circulation, there'll be perhaps even less money demand. There'll be even more of a resort to digital payments. So given that, it is true that M3 in India probably can moderate without really hurting the economy. That's all good. But the point is that India's monetary growth during COVID was not above normal. In fact, if anything, it was below normal. It has continued to stay muted in the subsequent period. And that is the key reason why inflation is well under check in India.
Sir, if we take the example of, say, Chinese economy, that's in trouble. US economy facing problems. European economy facing problems. how do you see the commodity cycle in the entire world?
Well, I think, commodity prices are likely to be moderating for the reason that you just cited. And a very important factor, apart from what I've already talked about, is the fact that the Chinese economy is not seriously recovering. So if you look at the April industrial production, retail sales, fixed asset investment numbers in China, they were all much weaker than expected. Now, if you remember last year, April particularly and May were the months in which Shanghai, the financial center of China, was shut down for almost the entire month because of COVID. So given that there was this shutdown last year, this year, the April numbers should have shown very strong year-on-year growth, but they did not. The Chinese economy is much weaker than markets were expecting. And there is no real scope for further monetary easing in China because there's a lot of capital flight that occurs anyway, and that capital flight will probably pick up if China were to try and ease monetary policy. So China cannot really ease or provide a boost, any kind of stimulus to the economy. And that is an important reason why commodity prices are weak, including coal. If you look at coal inventories in China, they're extremely high. So with Chinese coal demand moderating, the single largest source of demand for coal is seeing a significant shrinking. If you look at coal production and consumption, China is the biggest, India is the second biggest, but India is about 1/10 the size of production and consumption of China for coal. And so, although demand is strong in India for coal, the major factor is China's relatively weak demand, which is why coal prices have moderated as much as they have. And so you look at coal, palm oil, soy oil, all these prices have moderated very significantly. And of course, crude oil prices continue to trend lower despite the OPEC plus attempt at holding down production. So we basically have a situation where we have relatively weak commodity prices. India is a net importer of commodities, and India is therefore a beneficiary of weak commodity prices. It acts as a kind of tax cut for the Indian consumer and business.
That's the reason our Prime Minister is enjoying the trips in America and in Australia.
Yes. So, I mean, I think that's a different story. But yes, he was given a very warm welcome in Australia, and something similar is likely on his trip to the US later this month. Yes.
Because now we are contributing to the global growth, right, sir?
We are the biggest contributor now. Increasingly, as China's economy is relatively weak, India is a major contributor. But of course, the size of our economy is between 1/4 and 1/5 of China. So we need to grow a lot faster if you're going to be the biggest single contributor. But in terms of incremental growth, India is a major factor. We are clearly the fastest growing G20 economy, and likely to remain so in the year ahead. And so the rest of the world needs India to continue to grow strongly. And now I think with the Indo-Pacific Economic Forum contributing to strengthening supply chains and integrating India much more closely into global manufacturing supply chains, there is actually going to be a significant further boost to the Make in India initiative, which has grown in fits and starts, is beginning to gain some momentum now, but will probably benefit hugely from the IPEF partnership.
Coming back to the GDP growth, sir, where do you see the FY24 number for India in terms of agricultural growth, service sector growth, and manufacturing growth?
So in the year ahead, I'm looking, the current year, FY24, I think I'm looking at a real GDP growing by 7.2% again. I expect that the number for last year, FY23, will eventually be revised upward. Just as the previous year. If you remember, the previous year was originally reported at 8.6%. It's now been revised up to 9.1%. Long after everybody's forgotten. Nobody's paying attention to that year. Now it is revised up to 9.1. Similarly, 9 months from now, we'll see that the FY23 number will be more like 7.5 to 7.6%. And next, the FY24 number, I think, will be around 7.2. The key reason for 7.2% growth, in my view, is that fixed investment spending will continue to grow strongly. It'll continue to grow in double digits. I'd expect about 10.5% growth in fixed investment spending. Consumption should pick up a little bit as well, should accelerate a bit. And if you look at the sectoral breakup, I would expect that we'll get about 4.5% growth in agriculture. We'll probably get closer to 6 or 6.5% growth in manufacturing. And primarily because you'll begin to see the shift of supply chains that used to be centered on China. They'll gradually begin to be integrated will be integrating India into those supply chains. I'm not saying that there'll be a wholesale shift from China-centered to India-centered supply chains, but India will become part of these global supply chains, which should provide a huge boost in its manufacturing sector. So at least 6.5%, perhaps more. And services should continue to grow over 8.5%.
So last question, where do you see the rupee movement? Because we have seen that FY23 has not been a good year so far for rupee versus dollar.
Well, it hasn't been a good year for any emerging market currency. All emerging market currencies have depreciated a lot over the past year, partly because the US was raising interest rates so sharply, raised interest rates by 500 basis points or 5 percentage points in the last 14 months. And so that sucked in some money flows away from the emerging markets towards the United States. But now as we get to the end of the US rate hiking cycle, I think emerging market currencies will have a much easier and better year this year. I think India has been quite smart in letting the rupee stay relatively stable against the US dollar since November last year. Since around 5th of November last year, the dollar began to depreciate against its basket until about a month ago when it began to edge up again. But during the period from November until now, the rupee has been broadly stable against the US dollar. And I think that stability will continue with a little bit of a strengthening tinge in the current fiscal year. So I would expect that the rupee will end this fiscal year slightly stronger in the 81.5 type of range than it is currently. So basic stability against the US dollar, but the dollar itself continuing to depreciate against the euro and the pound, because the euro and the pound are two currency areas where central banks need to do a lot more. Central banks will actually be raising rates a lot more in those places. So those currencies will appreciate. And India will be broadly stable. The rupee will be broadly stable against the US dollar over the course of the current fiscal year.
Thank you very much, sir, for joining and thank you for your precious time. तो यहाँ पर बासु सर हमें बताते हुए कि जीडीपी ग्रोथ के डेटा में किस एक शानदार हमें आंकड़ा देखने के लिए मिला और जिस तरह का ग्रोथ आउटलुक सर ने दिया वो भी एक काफी पॉजिटिव साइड पर ही FY24 के लिए दिया गया है और क्रूड ऑयल को लेकर और रुपी डॉलर को लेकर सभी जो एस्पेक्ट्स हैं सर ने अपना आउटलुक दिया है और इंडिया एक बार फिर FY24 में जिस तरह का जीडीपी ग्रोथ में अभी तक एक अपना पैटर्न बनाकर चल रहा है कि ग्लोबल लीडर की तरह काम कर रहा है उसी तरह से FY24 में भी शायद करता हुआ नजर आए। फिलहाल इस कार्यक्रम को यहीं पर विराम देते हैं। धन्यवाद।